Hey everybody, this is for my ACC 204 course, Federal Tax. We are on Chapter 8, Depreciation Cost Recovery. Had a few questions about this. This was actually probably the chapter with the most questions. Generally, I get a few every week, different students, and I'm always here, so I'm happy to help. Notice that this one, we got a lot of questions. So this is a difficult chapter. The computations, are a little intimidating at first. I think once we get into them, you'll quickly see that it's not that'll become more routine, right? So it won't be as difficult. So I apologize. I was hoping to do it 3 o'clock yesterday. Those that were going to go, I had to cancel, and I explained why. So I apologize for that. But hopefully this video helps. My thought is I'll do a quick lecture, go through the main topics, and I had a few people ask for examples. So I will try to give either an example from the homework, or maybe I'll do an example on my own in Excel in another video to follow. So let's take a look and see if we can walk through some of these slides on depreciation. So if you took financial accounting, you know that in financial accounting, depreciation was pretty standard. You took the cost of an asset and you depreciated on a straight line basis based on the useful life. And the useful life was determined by management on the financial accounting. For tax, it's different. For the IRS, for IRS, the tax tables are set. So the useful lives for the different asset classes are set. And this could be for real property, it could be for residential property, commercial property. The tables are set, and the question is just what calculation to use. So let's go through for a minute, and let's just talk about some of our cost recovery and depreciation, right? So the property that we're talking about includes both real property and personal property, right? So or we could call realty property and personal property. So realty property includes lands, buildings, and anything affixed to those buildings, where personal property defines an asset that is not realty. So the personal property includes furniture, machinery, equipment, any other asset that is movable or not affixable to the land. So we have realty property and we have personal property. Right. So the realty property is for residential, non-residential buildings. The personal property is for furniture, machinery, equipment, and the like. And so based on those different types, we're going to have different tax tables. And the key is when we're placed in service. So the cost recovery begins not when we purchase the asset, but when it's placed in service. The definition for placed in service is when we start using the asset for its intended use. We'll skip over that for a minute. I want to get into the markers. So markers, MACRS, Modified Accelerated Cost Recovery System. Markers is what we call it for short. MACRS is the current depreciation system that we use. It's called a cost recovery system, right? But really what we're going to use it for is depreciation. And depreciation is important because depreciation is deductible on the tax return as an expense. So the more that you depreciate an item in the early years or the later years, the higher your deduction is, right? So some people might be incentivized to accelerate the depreciation. So here we have our modified accelerated cost recovery system. And this is the cost that we recover over a period of time. And generally it could be shorter than the economic life. So Markers provides a separate cost system for realty, for realty and personal property. So realty property and personal property, again, realty, land, buildings, anything affixed to the land. And personal property would be everything else that's not related to to the residential or land, which would be machinery, equipment, and the like, right? And based on those, it's the tables that we choose, right? So if we have personal property, so for personal property, the basis, the useful life, the method that we're going to use to depreciate, the number of years, can be 3, 5, 7, 10, 15, or 20. And it's going to depend on the type of the personal property, right? So furniture, fixtures, generally 7 years. Equipment is generally 7 years. Computers are generally 5. They could be 3, but they're generally 5. And based on that, it just the years matter, because the years will determine what we use in the table, right? So the other important note for personal property is that we use what they call the half-year convention. Half-year convention is important because that's going to be the name on the table. So if you have a personal property asset, let's say it's equipment. Equipment is 7 years. So you have a 7-year asset. It's personal property, and personal property uses the half-year convention, which means we're going to assume that on the first year, it was placed in the middle of the year. So we get 6 months in the first year, we get 6 months at the end, right? So we use the half-year convention. But for us, we just have to look for the correct table. So I'm going to stop my share here for a minute, and I'm going to pull up the table. These tables can be found in the text. So let me pull up my Zoom. Let's share the screen. All right. So these tables can be found in the textbook. In the back, there's a section, there's exhibits on the modified accelerated cost recovery system tables, the markers tables. So let's go take a look. So if we go to exhibit 8.3, and if we know that we have personal property, and personal property uses the half-year convention, once we know the useful life, so if this is equipment, it's 7 years, we simply have to know the year that it's placed in service. That's all we have to do. So for year 1, we're going to take the cost of the asset. The cost of the asset that we're going to depreciate is the depreciable cost, and we're going to multiply it by 14.29%, and that's my deductible depreciation for year 1. In year 2, I'm going to perform the same calculation. I'm going to take the cost, and I'm going to multiply it by the 24.49%. And I'm going to keep on going down the line and performing these calculations in order to get the deduction. And you'll notice, because we're using an accelerated depreciation method on the 7 years, we're looking at 200%. We're going to recognize more expense in the earlier years. You'll notice that these percentages are higher in the earlier years and less in the later years, right? You'll also notice that in year 1, it's slightly less than year 2, even though the goal of the modified accelerated cost recovery system is to depreciate more in the early years. The reason why is because we're on the half-year convention. So 14.29% is the half year. The 24.49% is what we'll see on the what we'll see for the full year in year 2. So that's what we see for the full year for year 2. And so just to clarify, we were talking about these tables. I paused it for 1 second because I caught myself making a mistake. So the original year 1, we're going to use the cost basis, the basis in the asset. But the key for these tables is that as we depreciate, right, when we get to year 2, we're going to use the 24.49%, right? But in year two, it's going to be the cost basis, the original cost basis, minus the previous year's depreciation or really accumulated depreciation. So each year, your adjusted cost basis is going to decrease by what you've depreciated in the past, and you'll multiply it by these rates. A good way to look at this is a calculator here, which I'll email this calculator tonight. It's just on a website. You can find the modified accelerated cost recovery system calculators anywhere, but I'm going to show you a calculator real quick. Let's share the screen. We have lots of screens open. So here, I'll share this link, right? So here's an example that we're going to look at. We have a calculator here, right? And we have a cost basis of $50,000. We placed the asset in service on January 2021. It's a 7-year useful life. So let's say it's equipment. We're using the half-year convention because it's personal property. And in the calculator, you simply put it up here, right? Half-year convention because it's personal property. We can also choose the mid-month or the mid-quarter, but personal property is the half-year. We'll talk about a difference in a minute. So if we go down below, we see that in year one, the adjusted basis would be the $50,000. We would multiply it by the 14.29%. So the depreciation deduction in year 2021 would be $7,143, right? In year two, we're going to take our cost basis of $50,000 and subtract it by the $7,143, the previous depreciation, and we get an adjusted cost basis of $42,857. We simply multiply it by the rate in the table. So our depreciation for year two is $12,245. Our total depreciation for year one and year two is $19,388. We continue the process. In year three, we're going to take the year two adjusted cost basis, subtract it by the there's two ways that you can do this. One is you could take the year two adjusted cost basis and subtract it by the year two depreciation to get to $30,612, or you could take the original cost basis and and subtract it by the cumulative, and that gets you to the same $30,612. You multiply that by the rate, the 17.49, and you get depreciation of $8,746, and you keep going on until you've taken up all of your depreciation. In year seven, your cumulative depreciation is $50,000, right? You've used up all your depreciation. Your cost basis was $50,000. So your book value in this column is now zero for the asset. So that's how you calculate the MACRS, MACRS, modified accelerated cost recovery system. Is you in year one, you find the cost basis, you multiply it by the rate on the table, and then as you accumulate the depreciation, you adjust your cost basis and multiply by the rates given in the table. So in this calculator, because it's real property, you can see we're going to use the rates given at a half-year convention. So let's stop. Because half-year convention, we're going to apply again. We're going to bounce around a little bit here. The half-year convention is used for personal property, which is anything that's not real estate, right? So for personal property, we use the half-year convention. The asset will be in place for half a year. For us, the important piece to know is that we just got to look for the half-year convention. The only time that we won't use a half-year convention is if we use a mid-quarter convention. A mid-quarter convention applies to personal property if more than 40% of the cost was acquired in the last quarter of the year. So if we acquired more than 40% of the cost in the last quarter of the year, then instead of the half year convention, we have to use the mid-quarter convention. What that means is that the depreciation on that real property is going to be slightly less in year one because we're going to reduce it, and we can see that in the calculator. So I'm going to stop here for a minute, and I'm going to pull up my calculator, and I should probably share it with everybody. So for those that I talked to yesterday, I'm still not feeling 100%, so I'm bouncing around. So hopefully I don't miss anything when I go back and forth on the video. So same basis, 50,000, right? Same year, 7 year. But let's say that instead of, so let's say that on the first example that we purchased it on January 1, 2021, let's say we purchase it in the fourth quarter, right? The fourth quarter of the year will be October. The calculator is not smart enough to change. We have to change it. If we purchase the more than 40%, so in this case, 100% we purchased in Q4, then we have to use the mid-quarter convention. And we're going to calculate. And we're going to scroll down. And let's notice some of the differences here, right? So the difference is, now look at the table. So we have the same adjusted basis of $50,000, but the year one rate went from roughly 14% down to 3.57. We're going to have less depreciation expense to deduct from income in year one. In year two, though, we increased the percentage, right? We went from roughly, I think it was 24%, we can check in a minute, to 27.55. And we're gonna have a more depreciation in year two. This is because we're on the mid-quarter convention, and the rule is that for personal property, so anything not real estate, if it's purchased, more than 40% of its value is purchased in the last quarter of the year, the calendar year. So October, November, December. If that happens, then we need to switch from the half-year convention, right? We can see the higher numbers, the 14 that, and then year one, and then it goes down a little bit in year two to 24. We need to switch it to the mid-quarter convention because that's the rule. And when we do that, we have less depreciation year one. But notice that the calculation mechanics are the same. So we have the cost basis in year one multiplied by the rate. That's the depreciation deduction in year one. We then go to year two. We subtract the year one depreciation, and we get an adjusted basis in that asset of 48,214. We multiply it by the rate, and we get a depreciation for year two. In year three, same thing as with the half-year convention. We can either take the original basis and subtract it from the cumulative in order to get to 34,439, or we could take the adjusted basis from year two and subtract it from the year two depreciation. Either way gets you to the same results. It might be easier just to use the original cost basis minus the cumulative, but everyone has a different way to do it. You get to the same book value as zero, and the depreciation looks the same, where it's the half or mid-year convention in year one, so it's slightly less. It's higher in year two, and then it goes down. So the modified accelerated cost recovery system, the goal is to get more depreciation in the early years and less in the later years because it's an accelerated system. So that would be personal property. The key takeaways is that if you buy it, if more than 60% of the value is purchased before Q4 or even during the year, then it's going to be the half-year convention. If it's 40% or more in the Q4, then it needs to be the mid-quarter convention. You can use that in the calculator, which I'll set. So let's stop that share and let's go back to the slides. All right, so let's go back. So So that's the mid-quarter convention, right? So we talked about that. And then here you'll see an example of the difference if you purchase the asset in Q4. You'll see some of these rates have changed, right? I'm going to skip over the qualified improvement property. Straight line election can be chosen. It's just a different chart. So if you look at the appendix, there's a straight line election chart. So there'll just be different rates. There'll be different rates for the straight line election. So we could take a look at that. But I next want to go into realty. So realty is important. So we just covered personal property. Personal property, mostly you're going to use the modified accelerated cost recovery system. Charts, you can choose the straight line method as well. Straight line method is similar. You can see it. The only difference is on the straight line method, you're going to use the cost basis every year, and you're going to straight line it out. But you can see the charts in the appendix. For the realty, it's a little bit different. So realty is defined two ways. We have residential realty, which is 80% or more of the real estate is residential, and that's going to have a different table versus the non-residential. So commercial buildings are strictly zoned commercial buildings, and you'll see that the residential real estate has 27.5 years useful life, whereas non-residential is 39 years. Important note, so both types of realty, residential and commercial, use the mid-month convention. The mid-month convention simply means that whenever you purchase whenever the asset is placed in service, you're going to place the asset, you're going to start the depreciation in the middle of that month. So if it's the beginning or end of the month, doesn't matter. It's going to be in the middle of that month. Okay. So in this example, if we placed an asset in service on June 2nd, we're going to start depreciating on June 15th, a mid-month. What does that mean? It means if we go to the tax tables, using our same calculator, if I can find it, there it is. All right, so what happens if, I'm just looking for so if the basis, right here, so we could find the type of asset, whether it's realty or personal here. So let's use a 27.5. So we have the 80% rule, the residential rental property, right? And we know every time, if it's residential or commercial real estate, right, we're going to use the mid-month convention. We click on calculate. And when we do, we get our amortization schedule, our depreciation schedule, right? Here we place the asset in service in October. So with the mid-month, we would start depreciating on October 15th. And you'll notice we get the rates right from the table. So we get the cost basis multiplied by the rate. That's the depreciation. And because it's an accelerated method, we use the same formula. It's the adjusted basis minus the cumulative in each year multiplied by the rate. So in year 2, the adjusted basis is 50. We subtract it by the 758 cumulative. Our adjusted cost basis in year 2 is 49,242. We multiply that by 7.16, and our depreciation in year 2 is 3,581. We're going to continue that process all the way down until finally in year 27, right? 27.5, so 27 years, 6 months. At the end of that, we will have depreciated the asset fully, so our cost basis is 0. Cost basis is, or our adjusted cost basis is simply, adjusted cost basis is the cost minus the accumulated depreciation. So every year that we depreciate, our cumulative depreciation increases. If we change that, and if we go to the non-residential property. So for commercial buildings, you'll see that we have the same calculation, but we're just going to do it over a long period of time. So now this is 39.5 years. We go to 2060. The formulas are the same. The rates are just different. So when it comes to the MACRAs, the Modified Accelerated Cost Recovery System, step one is to identify what type of asset is it. Is it a realty or is it personal? If it's personal, then we need to figure out what it is. If it's and typically in the book, you'll see equipment, which is 7 years, furniture, which is 7 years, or computers, which are 5, right? And if it's personal, then we need to figure out, are we going to use the half-year convention, which normally we will, or if we bought 40% or more of that asset value in Q4 of the calendar year, we might have to use the mid-quarter convention. So that's for personal property. For realty property, we're always going to use the mid-month convention. All we need to figure out is whether or not it's a residential or a commercial property. Residential is 27.5, commercial is 39. I'm going to send an announcement with this link in there. I apologize for all the ads, right? Like I keep getting ads to buy tickets to Nirvana or something like that, which I don't think they're playing anymore. But long story short, it's a cool calculator to use. There's millions of these calculators to use. I think the visual's good. Take a look. But let me keep going in the slides because there's a few other things I'd like to cover. So let me go back to the share. Let's talk about the 179 rule. So we have a special rule where you can deduct the full value of the asset up to $1,040,000 set in 2020, which I believe is the same for 2021. There might be a slight difference, but it should be the same for 2021. So the Section 179 rules allows you to deduct the full value of that asset. And the limitation is you can deduct it up to the income generated in the year. So you can't take a loss by deducting a 179 deduction, but you can deduct up to that limit, 1,040,000, limited to the net income. And what the Section 179 does, it gives businesses an incentive to go buy property. Right, it gives them an incentive to buy property, or assets, so property, assets, capital, and to get that big deduction from that purchase to offset net income. And this is before you then take the rest. If you bought more than 1,040 in 2020. And whatever the value would be in 2021, which we can look up in a minute. But the difference between the two, then you would depreciate normally. But this is a real accelerated because you get to depreciate the full 1,040,000 in that year. It's an incentive for businesses to buy capital assets, right? But there's some limitations. So the ceiling is 1,040 in 2020. And there is the limitation where you can only offset income. You can't generate a loss from the deduction. There's also a ceiling, right? Oh, well, the ceiling is the 1,040. There's also a rule where there's a dollar for dollar reduction in the Section 179, up to $2,590,000. What does that mean? That means if you bought $2,590,000 worth of so I take that back. So what that means is that if you in excess, that's what I was trying to get out. If you purchased in excess assets and placed them in service in a given year over the 1,040. So let's say in this example, you placed $3,630,000 of assets in service in the year, right? If you did that, we would take the potential section 179, add the difference, in this case, which would be 2,590,000, which gives you to the 3,630,000. Because the difference equals the 2,590,000, there's a dollar for dollar reduction. We would get $0 in section 179 allowance because we purchased so many assets. So there is a ceiling on it. If you exceed more, this is more for a small mid-sized business deduction. Here's a calculation on the 179 deduction. So in this example, Jill owns a computer company or a computer service company. It's 2020, so the section 179 is capped at 1,040,000. So if Jill goes out and spends $2,730,000 on new equipment, what would her 179 expense deduction look like, right? So let's take a look. So she's allowed $1,040,000 in section 179 deduction, but she's purchased more than the $1,040,000. She's purchased $2,730,000. So once you exceed, and I should have said that, once you exceed the $2,590,000, you then get pulled into this dollar for dollar reduction. It's a rule. So if you spent less than 2.59 million, but more than 1,040,000, you wouldn't trigger this dollar for dollar reduction in your section 179. It's in excess of the 2,590,000. So Jill spent 2,730,000. So she needs to take the 2,730,000, subtract it from 2,590,000. So the dollar for dollar reduction is $140,000. So we take the section 179, which Jill is entitled to, at 1,040,000, but we need to deduct 140,000 because Jill exceeded the $2,590,000 cap in assets that you can place in service to get and still get the full section 179 deduction. So the formula would be the total assets placed in service minus 2,590,000, and that's the dollar for dollar limitation on the section 179. So you subtract that $140,000. So Jill is entitled to a 179 deduction adjusted at $900,000. Okay. But in addition to that, Jill is limited to income. So Jill earned an income of $138,000 before the 179 deduction. So Jill is only allowed to deduct $138,000. Her net income for the year would be $0, and she could carry forward $762,000 of 179 deduction to be used in later periods. So this is the section 179 deduction with the slide. So please take a look at that. I'm trying to see what else we should look here. There was something, I might have missed it here, but there was a question on the homework. And I'll just talk about it because I might have missed it somewhere along the way here, but there was a question on the homework on, and I think it was actually here. Let's go back to the beginning. So there was a question about Dr. Payne, right? So Dr. Payne purchased, let's move this so I can see. There we go. So Dr. Payne purchases a residence for $480,000, right? Dr. Payne then converts it to a rental property. And let's see where we went with that. Yeah, there we go there. So Dr. Payne takes the $480,000 purchase and converts it to a rental property, right? So Dr. Payne moves and decides to rent it. The rule is that the basis of that property, the basis of the property is the lesser of the fair market value or the cost or the original cost basis of the primary residence. So the primary residence had a cost basis of $480,000. If when Dr. Payne, on the year that Dr. Payne makes the election, if Dr. Payne elects to convert that property to real estate, then the new cost basis will be the lesser of the fair market value at the time of the conversion or the original primary residence. And here, I think the example was 250,000. If the fair market value goes down, let's say the market crashes for real estate, Dr. Payne's fair market value for the house is now 250,000. So Dr. Payne is quote unquote underwater, right? So Dr. Payne says, well, I'm not going to sell the house. Instead, I'll rent it. And maybe I'll make some money and the house will appreciate back to the original cost basis. If that's the case, on the date of the election to a rental property, then that rental property would have a fair market value of the fair market value would be $250,000. The new cost basis would be $250,000 because the rule is the lesser of the cost basis, which is the 480, or the fair market value on the date of conversion. Once you convert it, you would then depreciate over 27 and a half years using the mid-month convention on the calculator, because at that point it is now rental property, rental real estate, and rental real estate is allowed to be depreciated. You get a depreciation expense to offset income. You can't do that on a primary residence. So that was the piece on real estate. I think that covered what I wanted to talk about tonight. Let me know if you have any questions. I'm going to put an announcement with the calculator. Hopefully that was a good visual. We can use that calculator to calculate these adjustments, see the table. And then if you have additional questions, email me, and maybe if you want to do a Zoom over the weekend, we could try to connect over the weekend. You can call me or text me as well. So that was kind of a long video this week, but we did get a lot of questions, so I wanted to make sure we covered that. Thanks for viewing, and please reach out if you have any questions. Thanks, bye.